Welcome back to the Daily Crypto Deep Dive. Bitcoin is back above $65,000. After falling close to $58,000 during the June collapse, the world's largest cryptocurrency has recovered, pushed through one of the most closely watched price levels in the market and reached approximately $65,400. From a distance, it looks bullish. Bitcoin has survived another major sell-off. Inflation has cooled. Exchange-traded fund money has started returning. Short sellers are being squeezed, and some analysts believe the bottom may already be behind us. But when we look underneath the price, the situation becomes far more complicated. Spot trading volume has fallen. Aggressive selling has increased even while Bitcoin's price has risen. Michael Saylor's strategy has stopped buying. Options traders are paying more to protect themselves against another fall, and one major bank has warned that Bitcoin could still drop towards $53,000. So is Bitcoin beginning a genuine recovery? Or is this a rally being held together by one encouraging inflation report, borrowed money, and traders closing short positions? Today, we are going deep into the data, the exchange-traded fund flows, the analysts' forecasts, the technical levels, and the macroeconomic forces behind Bitcoin's return to $65,000. And at the end, we will give you our honest opinion on whether this breakout is real, or whether Bitcoin is walking directly into another trap. Before we begin, follow Crypto News Today and leave the podcast a 5-star rating. You can also receive 20 XRP when you sign up to Kraken through our link and complete your first qualifying trade. Once you have done it, send us a message so we can arrange your XRP. Okay, now getting back to it. To understand why $65,000 matters, we need to remember where Bitcoin has come from. Bitcoin reached an all-time high above $126,000 in October 2025. Since then, it has lost almost half of its value, falling below $60,000 during the most painful stages of this year's correction. The decline was not caused by one single event. Exchange-traded funds began suffering sustained outflows. Interest rate expectations became more aggressive. Investors moved money towards artificial intelligence companies. Geopolitical tensions pushed oil prices higher, and concerns emerged that cryptocurrency treasury companies could eventually become sellers rather than permanent buyers. Bitcoin became trapped between approximately $58,000 and $65,000. Every attempt to escape was met by sellers. That is why the latest move matters. Bitcoin is not simply crossing a round number. It is attacking the upper boundary of the range that has controlled the market for weeks. The immediate catalyst was United States inflation. June's consumer price report was considerably softer than economists expected. Headline prices fell by 0.4% during the month, while the annual inflation rate declined from 4.2% to 3.5%. That changed how financial markets viewed the Federal Reserve. Before the report, traders were increasingly concerned that the central bank might need to raise interest rates again. After the inflation figures were released, the probability of an immediate increase fell sharply. Short-term United States Treasury yields declined and the dollar weakened. Bitcoin responded almost immediately. It climbed more than 4% and closed above $65,000 for the first time since June. This is the bullish interpretation. Inflation is cooling. Monetary policy may become less restrictive, and institutional investors could begin returning to risk assets. CoinShares head of research, James Butterfill, believes Bitcoin has probably reached, or is very close to, its market floor. CoinShares recorded approximately $8 billion of global digital asset investment product outflows over an 8-week period, the worst sequence the company had ever recorded. But that streak has now started to turn. Approximately $287 million returned during the following week, with additional inflows appearing after the softer inflation data. If billions of dollars have already left the market, forced selling has slowed and investors are beginning to return, the argument is that Bitcoin may have finally exhausted the majority of its sellers. However, Butterfill is not predicting an immediate return to Bitcoin's record high. His view is that the downside may be limited, but the upside is also capped. CoinShares believes a sustained move above $80,000 is unlikely without a major change in interest rate expectations. In other words, the bottom may be in without a new bull market having started. That distinction is incredibly important. Bitcoin can recover from $58,000, hold above $60,000, and spend months moving sideways without returning anywhere near $126,000. A local bottom and a new all-time high are not the same prediction. The next piece of evidence comes from the exchange-traded funds. United States spot Bitcoin funds recorded approximately $181 million of net inflows following the inflation report. BlackRock's fund accounted for most of that buying. Nansen research analyst Nikolai Sondergaard believes the conditions for sustained inflows could return if inflation continues cooling and the Federal Reserve presents a credible path towards easier monetary policy. But he also warned that investors need to establish whether the latest inflows are durable or simply one trading session of repositioning. That is the central issue. One strong day is not a trend. Bitcoin's exchange-traded funds previously suffered 9 consecutive weeks of outflows. Even after the latest recovery, investors have removed billions of dollars from these products during 2026. For the bullish case to become convincing, the funds need to attract money consistently across several days and preferably several weeks. Bitcoin does not need one buyer arriving with $181 million. It needs hundreds of millions arriving repeatedly, regardless of whether the news on that particular day is positive or negative. Bitfinex analysts have described the current recovery as a borrowed bid. Their argument is that Bitcoin did not experience meaningful Bitcoin-specific demand before the inflation report. The Coinbase premium remained negative, indicating that Bitcoin was not commanding a higher price on the United States-based exchange. Strategy purchased no Bitcoin, and the exchange-traded funds had suffered a $424.7 million outflow immediately before the market recovered. Then one inflation report arrived. Interest rate expectations changed, and Bitcoin jumped. Bitfinex's concern is that a rally built primarily on macroeconomic expectations can disappear as quickly as it appeared. If oil prices continue rising, inflation could accelerate again. If the Federal Reserve refuses to become more accommodative, traders may reverse their positions. And if exchange-traded fund inflows disappear, there may not be enough genuine spot demand underneath the market to hold the price. This is why Bitfinex says Bitcoin needs to reach approximately $68,000, supported by sustained exchange-traded fund inflows, before the recovery becomes significantly more convincing. The $68,000 area is important for several reasons. It is close to the average acquisition price of many short-term Bitcoin holders. It also sits near Bitcoin's second quarter opening level and represents an area where traders who purchased at higher prices may attempt to escape without taking a loss. Breaking $65,000 gets attention. Breaking $68,000 and remaining there would begin changing the wider market structure. Glassnode's data creates another problem for the bullish argument. During the recent recovery, Bitcoin's spot trading volume reportedly fell by approximately 21.5%, declining from around $5.2 billion to $4.1 billion. More concerningly, spot cumulative volume delta moved from positive $17.2 million to negative $58.8 million. That sounds complicated, but the meaning is straightforward. Cumulative volume delta attempts to measure whether aggressive buyers or aggressive sellers are controlling the market. A positive reading suggests buyers are crossing the market and accepting higher prices to secure Bitcoin. A negative reading suggests sellers are becoming more aggressive. Bitcoin's price rose while this indicator turned negative. That means the rally was not necessarily created by an overwhelming wave of new buyers. It may have been helped by thin liquidity, short covering, and the absence of enough sell orders to stop the price moving higher. Imagine an auction with 1,000 people aggressively bidding for an asset. That is powerful demand. Now imagine an auction with only a handful of bidders, but almost nobody willing to sell. The price can still rise, but the move is far more fragile. That is effectively what the data may be showing. There is also a difference between spot demand and leveraged demand. Spot buyers purchase actual Bitcoin using available capital. Leveraged traders borrow money or use derivatives to increase the size of their position. Leverage can accelerate a rally because short sellers are forced to buy Bitcoin when prices move against them. But once the forced buying finishes, the market needs genuine demand to continue climbing. The current liquidation map shows a significant concentration of short positions between approximately $65,000 and $65,400. Bitcoin moving through that region can force bearish traders to close positions, producing an automatic wave of buying. That may carry the price towards $66,000. But after the shorts have been liquidated, the market faces a simple question. Who buys next? Options traders do not appear completely convinced. Bitfinex found that investors were paying a higher premium for downside protection even while Bitcoin was rising. That means sophisticated participants were willing to participate in the recovery while simultaneously purchasing insurance against another collapse. They were not confidently betting everything on continued upside. They were renting the rally while protecting themselves from the possibility that it disappears. Then we have the corporate buyers. Strategy currently holds 843,775 Bitcoin, but the company has now completed another week without adding to that position. It raised approximately $263.5 million through share sales, yet most of that capital was directed towards strengthening its United States dollar reserve rather than buying Bitcoin. This does not mean Michael Saylor has turned bearish. Strategy still owns an extraordinary amount of Bitcoin and appears committed to its long-term thesis. However, the market previously became accustomed to Strategy behaving like a price-insensitive buyer. It raised money, bought Bitcoin, and repeated the process. When one of the market's most famous buyers begins prioritizing cash reserves, dividends, and financial obligations, it removes one source of predictable demand. That does not destroy Bitcoin's recovery. But it means other buyers must take Strategy's place. Wall Street is also divided. Citigroup recently reduced its 12-month Bitcoin forecast from $112,000 to $82,000. The bank lowered its expected exchange-traded fund inflows over the next 12 months from $10 billion to effectively zero. Under Citi's bearish scenario, featuring continued fund outflows and recessionary conditions, Bitcoin could fall to approximately $53,000. That is the pessimistic institutional case. Investor demand remains weak. Regulation continues moving slowly. Corporate treasury companies become less aggressive and the economy enters a recession. But even Citi's central target of $82,000 would represent a substantial rise from current prices. The bank is not necessarily saying Bitcoin is finished. It is saying the route higher may be slower, weaker, and more dependent on external catalysts than investors previously expected. Fundstrat presents a more optimistic view. Sean Farrell, the company's head of digital asset strategy, believes markets may be underestimating the likelihood of the United States Clarity Act passing. Clearer legislation could encourage financial institutions to invest, build products, and hold digital assets without the same level of regulatory uncertainty. If regulation improves while inflation falls and exchange-traded fund inflows return, Bitcoin could receive several catalysts simultaneously. The problem is that none of those catalysts is guaranteed. The legislation could remain delayed. Inflation could increase again. Oil could remain above $90. The Federal Reserve could maintain restrictive policy. And the exchange-traded fund inflows could disappear after only a few positive sessions. So what should investors watch? The first level is approximately $65,400. Bitcoin needs more than a brief move above it. It needs a convincing daily close, followed by evidence that buyers are willing to defend the level. The next major test is $68,000. That is where Bitfinex believes several important market indicators converge. A sustained move above $68,000, supported by genuine spot volume and continued exchange-traded fund inflows, would significantly strengthen the bullish case. Below the market, $64,000 is the first important support. Losing that level would return attention to $63,000. A failure around $63,000 could expose the liquidity concentrated closer to $62,000. with the wider $60,000 region once again becoming the critical psychological battleground. Now for our opinion. We do not believe Bitcoin's recovery is completely fake. The market absorbed an enormous amount of selling, survived a fall below $60,000, and repeatedly attracted buyers near the June lows. Long-term holders did not panic in the same way they have during previous full-scale capitulation events, and the return of exchange-traded fund inflows, however limited, is a meaningful improvement. Our view is that the June low probably marked a local bottom, unless the world experiences another major macroeconomic shock. But we also do not believe Bitcoin has confirmed a new bull market. At the moment, this is a recovery attempt, not a confirmed breakout. The price is stronger than the underlying demand. We want to see three things before becoming considerably more confident. Several consecutive sessions of meaningful exchange-traded fund inflows, a recovery in spot trading volume, with aggressive buyers beginning to outnumber aggressive sellers, and a sustained move above $68,000 that survives even when the news cycle becomes less favorable. If those things happen, Bitcoin can begin targeting $70,000, then the wider region approaching $80,000. If they do not, $65,000 could become another temporary spike created by short liquidations and macroeconomic hope. The bulls have finally pushed open the door, but they have not yet walked through it. Thank you for listening to Crypto News Today. Follow the podcast, leave us a 5-star rating, and share this episode with someone who needs to understand what is actually happening beneath Bitcoin's latest rally. None of this is financial advice. Always conduct your own research and never invest money you cannot afford to lose. We will see you at the top.